Okay, good afternoon, everybody. This is Michael Deveres coming to you again with Alex Leykind. He's a commercial real estate broker. And I had Alex on recently on my radio show on Radio Freedom FM, and that was in Russian. And due to many requests, and because there was so much useful information given by Alex, we decided to do one more session in English. We're going to go through the same thing, and maybe we're going to add some more material. And for anybody who's looking to invest into real estate, build something, buy a commercial building, multifamily, you have to listen in, because Alex, he is the expert. He's the whale, the whale of commercial mortgages. So Alex, thanks again for joining me.
Thank you for having me.
I just wanted to say a few words about you. You are managing director of Equitas Capital Group.
Yes,
And you are a commercial mortgages veteran with extensive experience in arranging financing for real estate developers, multifamily property owners, and real estate investors. And
yes, sir.
Just some of the statistics so people know who they're dealing with. This year alone, you've closed 80 loans, which is a huge number, which means that you know what you're doing. That's why I want to invite you to educate people who want to invest in real estate.
Sure.
So let's start with, there's a misconception that it is very hard to get a commercial loan if you have a smaller down payment, that you need a huge down payment. But you told me when we spoke earlier that it is possible to buy vacant land and build something with a down payment that's not huge. Can you explain if that's so and how does that work?
Sure. So if we're talking about development, then the big misconception is that, a lot of developers think that they have to buy properties cash. They got to get it fully entitled. They got to pour foundations and they got to put in a lot of infrastructure. Where the case is that banks will actually finance, 50, 60% of the land acquisition. But banks will also inadvertently finance from 70, 75% of the total cost of the entire project, which a lot of people don't know that. Now, what goes into those 75% are 6 major factors. So the way banks evaluate it is based on the land purchase, soft costs, architects, engineers, hard costs, which is the actual, I like to say, bricks and sticks. Banks will always add a contingency reserve to make sure that the project can cover any cost bumps in the road, interest reserve, and closing costs. And when you add up all those 6 items, you get a big number. And depending on your experience and track record, developers could get anywhere from 65 to 75% of that total project number.
That's not so bad, especially if you have few partners together.
Yeah.
Put some money together and you can start a project. So you're saying that even somebody with no experience, let's say building in US, or no experience at all, they could potentially get a commercial mortgage.
So yes, if someone's looking to do their first project, there's a couple of avenues for them to explore. One avenue would be to potentially either invest more of their money and just borrow from a bank, but at a lower leverage point. Because there are banks that, depending on the financial strength of the project, will be able to lend to a first-time developer as long as other certain caveats are met. Or on the flip side, if they want to borrow higher leverage, there is alternative lending sources, not banks, that do carry a premium in interest rate, but it's readily available. And
so
for
somebody has,
I'm sorry. So for first-time developers, it actually makes sense, because instead of, going into a partnership with someone and giving up equity, I always like to say that, debt, even expensive debt, is cheaper than equity.
Right. True. And you have less of a headache dealing with somebody else.
Yeah. Absolutely.
But it's one venue to explore, to bring in somebody else that has more experience, to show to the bank, here, I have a partner who's an experienced developer. You're going to get better rates,
absolutely,
and, better terms on your loan. Correct?
Absolutely, yeah. And just to add, one of the offerings that we do have is for people that want to develop and are looking for kind of joint venture, we actually have a lot of different clients that would actively and are actively looking for joint ventures.
Oh, that's amazing.
Yeah,
Okay.
so we could kind of, introduce the two.
All right, great. So let me get this straight. So if somebody has, let's say, some capital they want to invest, but they don't have the experience, you could team them up with a contractor or a builder that has experience, and they can do a joint venture.
Absolutely. Or if property, if it's not even cash, but property owners that have free and clear properties that they're not of the means to develop it themselves, we could coordinate partnerships where they'll put up the property and someone will come in and build it for them.
That is very interesting. Very, very interesting. Okay, great. Good to know. Now, let's go to different extreme. Hard money loans. Okay, that's for people that for them it's a last resort. They can't get money from a bank. They can get money from an individual who has the money that wants to invest at high interest rates. Can you explain how hard money works and whether you have access to such hard money?
Sure. So, we work with multiple private lenders. I think hard money has a very bad connotation. Everyone thinks, oh my God, I have to pay 12, 13, 14, 15% and 10
has
points.
The name. That's why it's called hard. It's not easy money, right?
But the difference is that private money, which I like is a much better, term. Private money could start from 6.5% and go to 12%.
Wow.
And everywhere in between. Now, I'm also of the firm mindset that private money is not a last resort. Private money is a tool that's used by very large commercial property owners and sponsors because it's an execution facility, meaning that private lenders could close in 4 days. And if you're looking to acquire a property, even though you could go to any bank and get a loan from any bank that you would ever want or your heart desires, banks just physically can't execute in 4 days. Private lenders can.
They have bureaucracy. They have underwriting department, legal department to go through. Hard money just could be potentially one guy who's making a decision on the spot like this.
Absolutely. And, we have, really strong partnerships with several of the private lenders where, when we do private placements, we don't do appraisals for the most part, right? Some of the lenders that we work with don't require appraisals. They don't require environmentals, right? It's basically the best way to understand private money is that private money is 98% driven by the collateral. It's driven by the property. As long as, the sponsor brings a little bit to the party, it's all about the property. Where's the asset? What's wrong with the asset? Why this? Why that? But it's all property driven. And as long as the property is solid, it works.
And what is the minimum amount that a private investor would consider?
$500,000.
Your experience. Okay. Understood. Okay.
Anything below that, just it doesn't make financial sense for them.
And on the other end of the spectrum, there is a SBA, Small Business Administration. They help insure and underwrite a loan, and those loans typically come at much lower rates, correct?
So SBA is a facility that's obviously insured by the U.S. government, but that product is specifically designed only for commercial owner-occupied properties.
Okay.
And just to be very specific, it's not living in a part of the property. It's your business has to be able to occupy 51% of the total building square footage or the property square footage. And the entire financial analysis is comprised solely based on the financial strength of the business and the business's ability to sustain the debt and repay back its obligations.
So that would be great, for example, for a doctor who's looking to purchase a condo.
It's fantastic for doctors.
A commercial medical condo. And SBA, again, they do provide lower rates.
SBA actually carries very aggressive pricing. And SBA is actually one of the only type of credit facilities in all of commercial real estate that could actually offer full-term fixed rates.
But I understand it could take a little longer to get processed because they do a lot of homework on the applicants.
So I tell every client that we work with that, we coordinate SBA financing for, in which we do, a very large amount of. It's, to use a funny analogy, you're applying for a loan at the DMV. You're borrowing.
You gotta have patience. You gotta have patience.
It's extremely thorough. Extremely thorough. There's a lot of back and forth. It does take time because the SBA is what a lot of people tend to forget is actually pretty busy these days. Besides doing the commercial loans, they're also handling the CARES Act and all the government subsidies because of COVID and everything else. So they're pretty busy. But I personally feel that it's worth the time.
It's worth it.
On average, it takes 75 to 90 days. But the product is there and great product. It's fully deliverable and pricing is stellar. Pricing is sometimes better than banks.
So you apply to a bank that works with SBA. You don't apply directly to SBA, do you?
No. So the way that we run our process is we actually have a very strong relationship with the New York City Business Development Corporation, NYBDC, which is called Pursuit now. So that's kind of the SBA arm in New York. So there is a concurrent underwriting process where the bank that we will designate, whoever's going to offer us the most favorable commercial terms, they're going to take the first 50%. And then simultaneously, we will work with Pursuit on the SBA side of the house to handle the 40% that will come from them. And they run concurrent underwriting.
And if you're dealing with conventional loans, non-SBA, owner-occupied versus fully investment property, is there a difference in the process and the rates and so on? How does that work?
Absolutely. So on the owner-occupied side of the house, it still goes back to the same formula as with SBA. Your business needs to occupy 51% of the total property square footage. Most banks will offer 80% financing, conventional. However, we do have some capital partners that, especially for healthcare these days, are offering doctors 100% financing non-SBA, which I think that's a game changer. But that is on the owner-occupied side. On the investment commercial real estate finance side, I tell everyone that these types of loans need to be understood, and the way that banks evaluate them is as a business. So how do you evaluate any business? You look at their financial statements and you see, X amount of money comes in. These are our expenses. What's our, net operating income, which in my world, that's like the holy grail. And the net operating income will determine the maximum amount of financing that a property could sustain on its own merits. So what a lot of people don't know is that commercial properties need to be able to sustain their own debt obligations as a business. Banks extremely rarely will lend on a property where the sponsor has to dish out money every month to cover debt service.
Of course.
So the property has So the property has to be able to sustain itself on its own merits.
That makes sense. Speaking of risk, if somebody has a less than stellar, less than perfect credit history, is that a factor in commercial loans as much as it is on residential loans?
So it is a factor, and there is a minimum, right? Because once you fall below that minimum, it just changes the lender profile, which obviously causes higher risk profile, higher rate. Very simple formula. If you're within the 680 plus range, I think you'll be just fine. But if you start dipping, then there are repercussions for it.
And is there a personal guarantee on commercial loans usually? In other words, if something goes wrong, you don't repay. Can the bank go after you personally or only after your company?
So there are many different types of commercial loans. when it comes to recourse. So there are full recourse loans where the individual borrower has to offer a personal guarantee.
Okay.
There are partial recourse loans where, if you take a $5 million loan, you're only responsible for the first 2.5.
Okay.
There are burn-off loans where, it could be you take a long-term fixed rate, but, you'll guarantee it for the first couple of years. And if you perform like you're supposed to, then the bank will burn off or remove the personal guarantee. Okay. And then at the other end of the spectrum is non-recourse, which are no personal guarantees whatsoever.
I see.
Now, what on the personal recourse side, what a lot of people misunderstand and misinterpret is that a personal guarantee on a commercial property does not necessarily mean that the bank's going to come and take your house and take your personal money and take your cars and take your personal assets. That's not the case.
How does that work?
So the way the personal guarantee structure is, the bank will obviously foreclose and dispose of the asset.
Okay.
And they're
gonna sell it at an auction, for example.
They'll sell at an auction, and they want to recoup as much money as they can to offset their loan. Okay. And if they sell it for less than they're owed, the difference is what they could technically go after you for. Okay. Now, I think it's less and less of a risk to borrowers because the way that banks are lending today, no one's doing max leverage. Right. So because the leverage points are, conservative, and the way that banks underwrite the loans are very conservative, that, it's still New York. So if a property is being sold for 60 cents on the dollar, right, most 99 out of times,
enough equity. There's enough equity to satisfy the lender, so they don't have to go after you personally.
Correct. But from a legal standpoint, yes, technically they could go after you for the difference.
And do you do loans in every state or just in New York?
No, so we work on a national level. Obviously, New York is our favorite and home front. So I would say Northeast is a major market from Philadelphia to Boston. We're extremely active in the Southeast, so from Charlotte down to South Florida. And then, we do deals. We're doing several deals in Los Angeles. We're doing several deals in Texas, Chicago. Luck of the draw.
So let me ask you, because it seems like you have so much experience, so many deals going on in different states, different parts of the country, and in New York, different parts of New York City. Can you talk about what are some opportunities that you see for investments in US and in New York State?
Sure. So I think the commercial real estate market is on fire. I think that a lot of people kind of misgauged the impact of COVID. And, commercial real estate is a very big word, right? It includes a lot of different asset types. So yes, obviously certain asset types took it a lot harder than others, hotels, for instance, right?
Of course.
Where, let's say last year, banks were not even, you can't even say the word hotel. But guess what? The longer out of we go, now at least you could say the word, right? They're not fully back, but at least you could say the word these days.
Sure. There's travel again. People are moving around. There's a need for hotels again.
Absolutely. Now, all the other commercial asset types are on fire. And I think even more particularly based on certain geographies, investor appetite is different. For example, multifamily, which is a fan favorite across a lot of different, lender types, and a lot of different investor types. In New York, after the rent regulation laws from 2 years ago, it's making it tougher. Especially on the older properties that are in rent stabilization and rent control, it's very hard to destabilize them. That kind of, what it did is it kind of drew the investors in that space. It drew them to other parts of the country, which are, I would say, a lot more, landlord friendly states.
Yeah.
So the Charlottes, the Atlantas, the Floridas of the world, and so forth. Texas and so forth. That asset type is on fire there. The Northeast is actually doing extremely well with office.
Dude, that's shocking
And
to me. That is shocking because I would think in this new economy of remote, working
mhm,
remotely, there's less and less need for office space. And yet, you told me before, you're telling me now that there is a lot of opportunity, a lot of builders are actually, and investors going for office space. That means there's optimism in the market for the workers to come back, huh?
absolutely. So what basically really did change after the last time we spoke is, public information, a lot of Fortune 500 companies, stay home, stay home, stay home. Well, guess what? Now get vaccinated, come back to work. And we're not going to talk about the whole vaccine, so personal, prerogative.
Right, right.
Um,
But
but
but business wise, it's great
but
because
business
business
wise,
wise, yeah,
they're all coming
getting
back.
yeah, it's getting people back to work, it's getting people back into restaurants and so on. That's amazing.
And even more so, I think that the office market is very geographically specific, even within New York City,
Mhm.
because you have to look at the profile of the tenancy. When you're talking about the outer boroughs, the Brooklyns, the Queens, the Staten Islands, the Bronx of the world, the office space, it's not as sensitive to, having a beautiful 1 million square foot office building on Park Avenue,
Right.
where if you have a, corporate tenant walk out the door and they give up half of your building, then you're in trouble.
Mhm.
The issue is with the outer markets is they are predominantly being occupied by the service industry that really come and kind of domiciles that immediate local community. So
Mhm.
your local architects, your local CPAs, your local
Right.
attorneys,
They need offices.
they needed offices. People are
Right.
still going to go see their attorney. People are still going to go see their accountant.
Sure.
And what developers are really kind of really honed in on is they're building space that could be extremely easily convertible, meaning that I could give you 800 square feet, I could give you 8,000 square feet. I could give you anything in between, below, above, whatever you want. And I think that type of flexibility is what's really driving it. In addition to that, in most outer markets, you really don't have a lot of Class A office space.
Right.
And the developers that are building it are the winners.
Because they have the exclusivity on the market on these
Exactly right.
type A buildings. And what about locally where we are in Brooklyn, Shipsy Bay, Brighton Beach? What do you see with the condo market? Just with the residential condo, is it do you
No
see growth
slowdown.
there?
No slowdown. Developers
Perfect.
are building. People are buying.
Excellent.
We get requests all the time from sponsors. They're building condos, building condos, building condos.
See,
And,
I always say never bet against the big apple. We're coming back.
1,000% agree.
We're coming back, and we're coming back even stronger.
You know what? I think I could not agree with you more. I think it's already back.
Excellent.
I don't think
Good to
it
hear.
ever really, I don't think it ever really went away. It kind of just,
There was,
took a break.
yeah, there was a slump in perception. There was a lot of negativity. But now that people are seeing that COVID rates are going down, vaccination is going up, there's a lot of opportunity for the upside in real estate. That's what I see.
Yeah.
Alex, as always, it's been a pleasure talking to you. You're a true professional. And
Thank
what
you,
I'm
sir.
going to do is once I'm going to edit this video, I'm going to put your phone number on the bottom so people can reach you if they have any questions. And also, do you mind when I'm going to post on Facebook, I'm also going to tag you and people
Sure,
can
please.
they can message you directly with any
Please.
questions on obtaining
Would
a
be
commercial
my
mortgage.
pleasure.
Alex, thanks
Perfect.
so much. Have a great day. Thank you.
Thank you, Michael. Bye-bye.
Okay, bye-bye.